Joining us right now to talk about the markets ahead of today's big jobs report, Gabriela Santos. She is JPMorgan Asset Management Chief Market Strategist for the Americas. And this is a big number. We got some hints yesterday with ADP coming in. Did that foreshadow anything for you? What are you expecting, and what do you think it means for stocks?
Yeah, so I think when we look at a whole mosaic of labor market data, it's really telling us that the labor market continues to cool. It's not cool. We're not seeing massive layoffs, no big spike in the unemployment rate to come, but very clearly there's been a cooling in the demand for labor. So tomorrow we expect about 85,000, which would really bring the average over the last 3 months to about 54,000. Similar message from the ADP, the Conference Board labor market differential. You could look at a slight increase in things like continuing claims. So really suggesting cooling, but not cool. I think the most interesting thing will be next week on Tuesday. We get the initial annual benchmark revision of hiring from March 2024 to 2025. And we think that will bring down the monthly average by about 50,000. So this cooling seems to have happened and started a bit earlier, and it's continuing. So imminent rate cut to come.
I was going to say, it feels like the Fed is a little more focused on the labor market side of things right now than inflation, because inflation, they've been waiting and waiting to see what happens. It hasn't gotten kicked into high gear by the tariffs as some people had expected. But the labor market cooling, that's got to be something that's catching their attention.
Absolutely. And I think it was that July jobs report with the lower revisions, over 254,000 lower revisions to May and June, that really for them brought into balance more the labor market and the inflation side of the equation, which Chair Powell laid out at Jackson Hole. So I think at this point, very well priced, of course, is that 25 basis point cut in September for a total at this point priced in of 60 basis points, getting rates to 3% by the end of next year. So unlikely to rock the boat.
Let me ask, the reason that they're focused on the labor market more means that the reason for cutting is not a great one. It's because we're worried about a slowing economy. How does the market read that? Because I don't think all rate cuts are delivered equally. If you're giving a rate cut because, hey, we just can, it feels like we're a little restrictive here. That's one thing. If it feels, and inflation's not out of control, if it feels like we're doing this because we're really worried that the economy is starting to slow down in a major way, that's a different story.
I think for right now, we're still in that sweet spot for equity markets of we're still restrictive policy. We're talking about another 100 or so basis points to get back to neutral, a 3-handle. So far, so good. Really insurance cuts. I think if we start to see more rate cuts priced in, because of a bigger slowdown in the labor market, then that's not necessarily something good for equities. The one thing I'm worried about, though, is over the last couple of months, you've seen a big rally in cyclical stocks. Here, anything that's very tapped into and geared to economic growth, consumer discretionary, home builders, small caps, and that we think is just a sugar boost.
Although the home builders, the retailers, the Home Depots of the world, they're going to get a boost from a rate cut, because that's going to bring down mortgage rates, and that's good news for all of them.
One of the things we're thinking about is we really only expect cash-like rates to move lower. A big theme this year has been curve steepening, and especially the last month has been a term premium increase, and especially the 530s by 30 basis points in August.
Meaning you think it's not going to bring down mortgage rates.
That's right.
It's only going to bring down the short end of the curve.
That's exactly it. So 1 year and below still has to come down 100 basis points over the next 12 months, but not the rest. So that's where we think for equities, we should really focus on structural, not cyclical.
Let's bring this back to the S&P 500 closing at a new high yesterday. Some people say, fantastic, this is momentum, you cannot fight this market. Other people who are really focused on risk assessment think, wait a second, now it's a little riskier because prices are higher.
So I think
which camp are you in?
I think broadly constructive still. Companies are still surprising on the upside with earnings nearly double digits. There's been a healthy broadening out of returns.
So the price increases are deserved?
I think so. Yeah. Just that one area where we see a slight increase in cyclicals breaking out to new highs, that's the one area we think is short-lived. Otherwise, you've seen a broadening of the AI theme to other tech companies, industrials, utilities. That's healthy. That's sustainable. The other place I would put a structural is actually financials. it's not really a cyclical story. It's good enough for banks,
right,
but it's much more that other side of the regulatory cycle that's really exciting there. So overall, a healthy rally in equities. It's just that it becomes more muted from here, and then really we start increasingly favoring Europe, Japan, and EM ex China.